Chapter 6, dealing with computing gains and losses. And then we have Chapter 21. So Chapter 6, we know the simple formula under 1001. 21, we moved into the character of the income, right? What is the character of the income? And this is pretty much to where we are today, but I did want to state three things for the record that I just know in the past people have screwed up, okay? So what's more valuable to taxpayers? So, missing yours? Yeah. Are more valuable, deductions or credits, guys? If you're given a choice, do you want a deduction or a credit? Deduction. Gotta review this. I hear two different answers. Deduction or what did you say?
I did deduction.
A deduction.
I don't know why, but
right?
I think I would take.
And who said credit? There's limits to, and deductions sometimes can be limited as well, right? Say this, guys. You always, if possible, dollar for dollar, you want a credit, not a deduction, because credits save dollar for dollar any tax due. Where a deduction, you get it if you earn $100,000 and you get a $10,000 deduction, your tax rate's 30%. You just save $3,000. If you get a $10,000 credit, you save that amount dollar for dollar. So if you get a $10,000 credit versus $10,000 deduction, always take the credit. Agreed? Emphasize something. We know from chapter 6, get a loss. What must you have? Realize, recognize, and allowed, right? And let me just point out something that sometimes, again, people for exam purposes or practitioners miss, but not you guys. Suppose you buy a car. Who just bought a car? Anyone? Okay. Rob, you bought a car, right? And if you don't mind, how much did you spend for it? Let's just say 40, okay? And how long ago was that? Let's pretend it was 3 years ago. Okay, Robert? Okay? And he bought the car for 40, and 3 years later, Robert, make up. How much is it worth? You're lucky, but let's just let's just assume. Let's just say it sells. Robert, after 3 years, is like, I'm done with this car, and he sells for 26. Okay? Bought it for 40, sells it for 26, and he sat in tax class, and he sells the car. Have a loss. You guys can handle the math. He has a $14,000 loss, right? Is that loss, Robert, allowable? All right, I'm glad I'm having this conversation. No!
Because it's depreciation.
No, it's not depreciation, Kyle. Are personal losses allowed?
No.
They're not allowed. Code section 165 only allows losses from investment. Personal losses are not in that column of allowable. Because lots of people lose money on their house, right? Their cars, all sorts of personal items. I guarantee that plasma TV you bought 8 years ago, did you get the same price you bought it for? Hell no, right? Can you take a loss in your tax return for it? No. Right? Again, not every loss will be a recognized loss, right? Jordan, you agree? I'm sure you do. And then let me state for the record, for exam purposes, character. If I ask you the character, which we've spent a few classes, we're going to spend another. What is the character of income? I have seen over the years people put down taxable income. Is that character? No. We'll respond with the word gross income. Is that character, guys? The kind of character we're reviewing? No. When I say character, I want to know if it's capital gain, ordinary income, right? Recapture income, which we're going to discuss. All sorts of character, but that's the kind of character I'm looking for, right? Make sure that if I ask, which I will, I want people to do well. I will ask you, what is the character income? Do not respond with the word taxable, okay? That will not help you, it will not help me. Now, quickly through chapter 21, just to remind ourselves, And we talked about computing capital gains, capital losses, the capital loss limitation rules. What is a capital asset, right? Hopefully I made for some good dinner conversation with friends and family over the weekend. You were commenting about women's eggs and all sorts of other fun things of how that's treated for tax purposes. We talked about how taxpayers want to hold things for long-term holding periods, right? Code section 1222 for more than 1 year, because if they do, they secure long-term capital gain treatment. I believe we left off on page 722. Any questions? To date, or you guys ready to hit new information? Guys, page 722. Taxpayer cash method. Taxpayer engaged in the following transactions and shares of stock. What is stock? What kind of asset, Wendy? 21, right? It's not within the scope of any of the exceptions, right? What are the exceptions, Galena? Exceptions.
Inventory.
Inventory. Keep going.
AR and NR notes receivable.
Okay. And third, so we have inventory, accounts receivable, and
The derivatives.
31 assets, if you want to sound cool, right? Assets used in a trade or business. So generally, all assets are capital assets with the exception, those exceptions, right? Okay, you got that? Assets are capital assets except those three. Okay. Taxpayer, cash method calendar, taxpayer engaged in the following transactions, which we just read. Question A. A bought 100 shares of stock on January 15th of year one, costing $50 per share. T sold them on January 16th of year two at $60 per share. So we hear the word sale. Shia, what code section do we think of? 101. What's the amount realized? Realized. 6,000, right?
Yeah.
What's the basis? Section 1012, right? Gain or loss here, Shia? Gain of 1,000. Everyone agree? Everyone can handle that, right? No problem. Agreed? Okay, you're on a roll. Long term or short term? And then, Max, see if you agree. Long term. Max, is that right? More than 1 year? Why? When is the starting period?
January 15th.
The next
15th or 16th?
Starting January 15th.
When does the holding period start, guys? Revenue rolling 66-7, tell us.
First the day after.
Starts the day after, right, Maduka? It starts what date? January 16th. Hey, Kyle, does that change your answer?
Yeah. So
Yeah?
short term.
You say short term. Justin, is that right or wrong?
It's the 16th, then it would be 1 year, so it'd be short.
Justin.
Yeah.
Positive?
Yeah.
Your birthday, buddy?
Yeah.
Your birthday. Are you exactly 1 year old? Exactly 1 year? Or a year and a day when you blow out the birthday candles?
Exactly 1
Really? Are you the next year? Aren't you
Wait a
1
minute.
year? How old are you, Justin? Your birthday candles next. Aren't you going to be 27?
Yeah.
For the day, buddy.
year. How could you have this?
What's your birthday?
October 28th.
Next October. This upcoming October 28th. Isn't it going to be a year and a day from the following October 28th? Exactly 1 year. The day.
So I had the right answer.
You did. Be strong. Justin, I don't think you believe me.
Must be missing.
Oh, You gotta figure it out now. Your birthday, when you celebrate your birthday, it's a year and a day later. It's not exactly 1 year.
Okay.
October 28th to October 27th is exactly 1 year. October 28th to October 28th is a year and a day. Okay? That's why you celebrate your birthday. Monday, because that's 2 days after the tax event. So we can celebrate your birthday together here.
Oh.
And we'll know it's a year and a day, Justin. All right, everyone agree? Long term? Room for whimsiness here. T bought 100 shares on February 28th of year one at a cost of $50 per share. T sold them February 29th, year two at 60. And I'm sure Shia would tell us what was the gain recognized. Yeah. Recognized in problem B. Question. Shia, you just did it in the prior problem. What? I didn't ask the amount realized. I asked the gain recognized. And that's 1,000. I cut to the chase. Right. Right, Shia? Okay. Maduka, Shervan, Kyle, that upper row. Long term or short term? Let's hear it, Maduka. Short term. Shervan.
Is it a leap year or no?
You read the question.
How many days in February during? I think it's long term.
I say long term.
So Maduka, you're the only contrarian, right? Maduka, when does the holding period begin here? Loudly. You guys have to go back. Is there a 29th 2 years in a row?
Yeah.
March.
Maduka, when is the starting period?
March 1st.
March 1st. Everyone agree? Getting me nervous out there, guys. Very
my
nervous.
knowledge is only tax. I don't know anything else.
Forget about the calendar, right? So, everyone agree? There's leap years. I'm going to really put you on the spot, Kyle. Happen how often?
4 years.
Thank you. So they're not going to happen back to back. Do you want to retract your answer this time?
So the holding period would begin March 1st
Right. And then when?
and March 2nd.
Better?
February 29th.
When does it end? How long is that? 1 year. And if it's 1 year, it's short term. It starts under the revenue ruling March 1st, revenue ruling 66-7, and it ends, right? And if you were talking to the common layperson and say, oh, how long of a period is this? Everyone agree? It's exactly 1 year. Justin, what's wrong? All right. C. He bought 100 shares at $50 per share on February 10th of year one, and another 100 shares at $50 on March 10th of year one. He sold 100 shares, sold 100 of the shares on February 15th of year two for $60 per share. Okay, so there's two different blocks of shares, right? So the question is, Shia, what's the gain or loss here? Not a trick question, Shia. 1,000 gain recognized, right, Shia? Absolutely, right? Now the question is it long-term or short-term? Use, right, regulation 1012-1C1, one little I, you should use FIFO, right? So it would be long-term. Everyone agree? Regulation, right there, it's cited right there again. 12-1C1I. T told T's broker to purchase 100 shares on December 29th of year one, the time when its price was $50 per share. The share was delivered to T on January 3rd of year two, was selling for $52 per share. He told T's broker to sell the stock on December 30th of year two, when it sold for $60 per share. It was delivered to buyer on January 4th of year three, or excuse me, January 4th of year three. We're selling for $63 per share. So Yin, go through the whole thing. What is the amount realized, basis, gain, long-term or short-term? Doesn't say it was delivered to him, but it was purchased, right, December 29th. Or short-term. Right, December 30th, Justin would tell you this, right? December 30th is a year and a day. Jordan, John, you're on this page, you're following along, I hope. Question 8. James D. Bob accepted the value of the stock on December 30th of year two. Okay, so it was $45 per share, and on January 4th of year three is $48 per share. What's the adjusted basis? Not a trick question. Shervan, what's the adjusted basis? Say again?
45.
What did they buy it for? They sold it for 45 or 4,500, right? Gain or loss, Shervan?
That's a loss.
How much? 500, right? Long-term or short-term?
To the loss.
Long-term capital loss. Yen, is it allowable? And suppose the loss, instead of being $500, is $5,000. In that case, that loss max be allowable?
Question.
If the loss was $5,000, would that loss be allowable? Section 1211, right? Just be forewarned, even if it's allowable, there may be a second limitation, right? Right. Your answer is $500 long-term capital loss. You may want to put an asterisk. If the loss was larger, a portion might be disallowed, right? If it was in excess of $5,000, excuse me, in excess of $3,000, or if this were a corporate taxpayer, the entire capital loss might be suspended, right? Father bought 100 shares of stock on January 10th of year one for $30 per share. And of year one, when they were worth $40 per share, so they had appreciated, he gave them to his son, who sold them on January 15th for $60 per share. So, first of all, does the son have income when he receives the stock? Does the son have income when he receives the stock, Robert? A, right? 102A, no income. But that's not the question du jour, right? And what basis does the son have in these shares? What basis? Tax basis, Wendy. It just says no income. What's the authority for the basis rule? Yeah. And 15. 6,000, right? What's the basis? Right? Great. So the gain here, gain recognizes 3,000. Capital asset is it long-term or short-term? You might think that, but the authors, right, direct you to code section 1223-2, right? Section say? Holding period transfers to the son's holding period. So is the son going to have a long-term or short-term? Very great, long-term.
The father's for it, along with the when he acquired it, transfers over.
Right. G. Father purchased 1,000 shares for $10 per share several years ago. The stock was worth $50 per share on March 1st of year one, date of father's death. Stock was distributed to T, meaning the son, by the executor January 5th of year two, and T sold it for $60 per share on January 15th of year two. The son's basis in the shares, Justin? Is that right, Nellie?
No. It is the basis of
Authority. Your authority. Wendy, what's her authority? Justin, it's the basis equal to fair market value rule, right? Market value rule. All right, so in that instance, basis is equal to fair market value. And what basis does the son have? $50,000. And what does he sell it for? Gain or loss?
Gain.
10,000. Long term or short term? He's at January 5th of year two, and then he sells it 2 weeks later, right? Days later. You might think short term, but look at code section 1223.9. We're going to open up the code section 1223.9. What does it say? If a person acquires property from a decedent, okay, asking to them, says such property is determined under code section 1014, and such property is disposed of within 1 year after the decedent's death, then such person shall be considered to have held such property for more than 1 year. Aha! Being kind to recipients, right? If the father bought the stock a day ago, dies today, bequeaths it to his son sells it the next day, all within a 2-day time span, the son can command long-term capital gain treatment. Everyone see that? Plenty of exceptions, right, guys? Warren, what's the problem, Kyle?
That be abused?
Unless you want to die, it's hard to abuse it. Right? There's a steep price for playing games here.
Oh, well.
It's not a great strategy to look in your clients in the eye and say, you know what? There's a real tax upside of you dying. Right? So,
Gotta be honest.
question H. Same as G above, except that T was executor of father's estate, and as such, T sold the stock on January 15th of year two for $60 per share to pay the estate's administration expenses. And the answer in H and G are the same. It doesn't matter who sells the stock, the recipient or the estate. In either event, if the shares appreciate, they get long-term treatment. Or even if they go down in value, there will be a long-term loss. Everyone good? Any questions on question one? What's the problem, Kyle?
I was just curious, since I was reading last question, you said 1223 and
3.9. Whoever sells stock, the recipient of stock, whether it be the estate itself
right.
or the beneficiary, will command demand long-term treatment.
References code section 1014 at some point.
We got 1014, meaning someone died, and then we have the holding period to find out.
Okay, so that's where they draft. All
Look
right.
at the heading.
All right.
Headings are important, right, guys?
Thank you.
Right? Again, for exam purposes, reminder. Any book, any note, just nothing electronic, okay? No Apple Watches, nothing electronic. Just bear that in mind. Full calculator. Question 2. Tracker paid $25,000 to acquire a five-year transferable option on a parcel of investment land to purchase the land for an additional amount of $225,000. At the time the land was worth $250,000. $250,000. 3 years later, when the land is appreciated $300,000, purchaser wishes to acquire the land. What results a tracker if he exercises the option and immediately sells the land purchaser for $300,000? Okay, so she's going to exercise the option, and let me just help you out here. Right? To me, question 1 is the big question. Question 2 is just trying to illustrate if tracker or tracker exercises the option. What's her basis? She's paid $25,000 for the option, plus she has to shell out another $225,000, right? What's her total cost to acquire the property, guys? You can handle the math, right? That's her cost basis, $10,12. What does she sell the land for, guys? $300,000. Gain or loss? How much? $50,000. Long term or short term? Words. Short term, guys. Short term. She only had title for a day, right? She exercised the option, she got the property, and then she sold title to the property. How long did she own the property for? A few minutes, days, I don't know, but not more than 1 year for sure. Short term. Compare that answer to question B. The option for purchaser for $75,000. Well, what's her amount realized? Right? Her amount realized is $75,000. What's her basis? There's a $25,000. She paid $25,000 for the option. The gain is $50,000. What code section 1234 says is that the character of an option is neutral. It depends on what the option is for. If it's for an option for inventory, if you sell the option, it will give rise to ordinary income. If it's an option for a capital asset, it will give rise to capital gain. So in this case, it's a capital asset. Is it long-term or short-term, that $50,000 a gain? She held the option for? Guess what? What's the character? Long-term. So if you were advising this client, would you tell them to exercise the option or just simply sell the option? Sell the option. Don't exercise it because, look, you're going to get long-term treatment rather than short-term treatment, right? Got it? That's what that problem's illustrating. What's the problem, Nelly?
Options. In one, she sells the option within 3 years and she gets 50,000, right?
We said yes.
Long-term capital gain of
Yeah,
50,000.
that's it.
But here, if she sells the property, she gets $50,000 short-term capital
If
gain.
she exercises the option and gets the property, she's going to have short-term. Yes.
Short-term.
No, short-term does not command preferential rate treatment. Long-term capital gain gets a rate preference, right? He purchased unimproved land on April 1st of year one, commenced construction of vacation residence, which was completed on January 2nd of year three. Before T even moved in, and on that date, he offered $600,000 for the house and land. His cost basis for the land is $200,000. For the house, it's $300,000. Remember, he has the land and the building. The proposed purchase price is eligible $250,000 for the land and $350,000 for the house. It can also be established that the construction of the house is 50% complete on January 1st of year two. The tax consequences to T if the sale is effectuated January 2nd of year three. This is an actual court opinion. At least in my margins, guys, I did a little graphic here because sometimes these things are hard to follow. I have a buyer who's willing to buy, right, $600,000, right? Everyone agree? $600,000, and T had paid, or has a basis here of $500,000. Everyone agree? Tax tells. Sure, factually, that it's a two, and I'm making this up out of thin air, but to me at least it's easier to visualize this. Suppose a construction, it was a two-story house. That's a door. I'll throw in some windows. All right? No, I'm never going to become Picasso, guys. I think you know that. And the question is, right, we know how much gain the taxpayer has. 50 on the land, 50 on the building, right? Everyone agree? What's the character of the gain on the land? Okay. What asset is it? All right, Justin, because Code Section 1221 says all assets are capital, except that there's an exception. Okay? One, capital asset. Was held for how long, guys? Short term, that 50,000. Term, right? They held it from day one. Everyone agree? Taxpayer held the land, so that's definitely long-term capital gain. It's completed all at the end of year two, but how much was complete after year one? Year one, the first story was complete, right? It took until the end of year two to complete the second story, right? So the 50,000, was that long-term or short-term? And if you were to review this Paul case, what the judge did, very judiciously, you might say, is split this in half and say 25,000 long-term, right? Because this part of the house, vacation house, was complete after 1 year, and 50% short-term because the second story all was in 1 year or less, right? I don't know. The judge was saying that seemed equitable. Does this kind of fact pattern come up all the time? No, but it makes for an interesting heuristic device, pedagogical device of just trying to illustrate some of the conundrums. If you guys remember, I was trying to convert you away from your religion of subscribing to capital gains on the face of it deserve preferential tax treatment. Again, one of the many complexities that capital gain preference rates introduce it. Were there no capital gains preference rates, I would not be drawing pictures of homes, right? Courts would not have to go down that path. Because all the income would be taxed at the same rate, so this would all be moot. But that's not my world, not your world for now. We have to deal with this. So just make sure questions 1, 2, and 3, everyone here can define when they ask the character of income, long-term or short-term, right? That's imperative. Don't just, on the exam, just put down capital gain, right? It would be good if you put long-term or short-term. Agreed? Page 723.
So the petitioner acquired the property from his father. And it was a lot and a 10-story office building. One of the companies that was in the office building, they wanted to end their lease early. So they gave him the lease money. It was like 100.
To get out of the lease, okay? I'm gonna oversimplify it, but if the lease payments say were $12,000 a month or $120,000 a year, to get out of the lease, they gave the landlord, make up a number, 70,000. The numbers don't mean much here. So they didn't give the full 120. They gave 70 and said, "You don't want to stay here anymore. Here's 70,000." And apparently the landlord took it, like moved on. The question is, will the landlord report the 70,000 as income? Will the landlord instead say, "Hey, I should get a $50,000 loss because, hey, I was going to get 120, I only got 70. You do the arithmetic. I'm missing out on 50,000. What did the taxpayer do here, Kyle?
Sorry, what was that?
What did the taxpayer report?
Of like 20,000.
Well, in my example, he would have reported a loss of 50,000.
Right.
Egregious, Kyle.
Yes.
That's over the top, okay? Meaning the taxpayer created a phantom loss because got 70,000 of the 120 in my simplified facts. Say he suffered economically 50,000, it's over the top, right? And I think the taxpayer here quickly gave up on an argument. And then the argument became, how should he treat the 70,000 that he did receive? Certainly not a loss. What is the character of the income that he did receive? Is it going to be treated as capital gains or ordinary income? Kyle, do you recall what the court said?
Ordinary income.
Right. They said, hey, this is a substitute for rent. As such, there's no exchange of property. It was a rent substitute, and therefore, accordingly, it should be treated as ordinary income, right? That's the Hort case. I'll say it's a fairly famous case back in 1941, but remember, the code is pretty young at that stage. You'll see code references to the 1939 code, right? So just be forewarned, you guys are getting better at this. Metropolitan Building Company v. Commissioner. Here we have City of Washington, leases property, Metropolitan Building. Metropolitan Building leases property to Olympic Hotel. Olympic Hotel is a subleasee, right, of Metropolitan Building. Point, Washington would like to enter into a direct lease with Olympic Hotel and take Metropolitan Building out of the equation. Okay, so University of Washington would like to take Metropolitan Building. It is made Metropolitan to end the leasehold interest that it has. Made by Olympic Hotel and the leasehold interest Metropolitan Building has. And the question is, how should Metropolitan treat that? $137,000. IRS, of course, says that payment to Metropolitan should be treated as ordinary income and substitute. Now, is this a rent substitute? Say no.
Not receiving rent. changing the, I guess, the rights for the contract.
Right, they're giving up, in other words, here what Metropolitan Building is essentially selling is a leasehold interest. If you recall from your property, or your law class, what is property? It's a bundle of rights, right? And maybe it consists of 10 rights. And a sublease might say constitutes 3 of the 10 rights. And you can sell, right, a sublease. And in this case, essentially, Olympic Hotels was buying the sublease from Metropolitan Building. And as such, it should give rise to capital gain because it's selling an intangible asset. To use this property for X number of years is an intangible asset. It's a capital asset, right? Because it doesn't fit within the scope of any of the exceptions. This predates this case. Just to make sure there's an affirmation of this, look at code section 1241, guys. We're going to have code section 1241 open. 41. Amounts received by a lessee for cancellation of a lease. Now I'm going to skip some language. So it says amounts received by a lessee in cancellation of a lease shall be considered as amounts received in exchange for such lease. What the code does in PCB code section 1241, is you see the word exchange? The code creates, remember for code section 1222, to get to the promised land of having capital gain or capital loss, you need the word exchange. Here, the IRS was arguing essentially hotels paid Metropolitan, but there was really no exchange. Code section 1241 affirms that there is an actual exchange. Metropolitan Building, taxpayer essentially is sold sublease, capital gain treatment, but now you have code section 1241, which helps because relying on case law sometimes can be tricky. So the Congress came back and instituted code section 1241 to make sure this was the tax treatment. That's Metropolitan. The sale of a sublease will give rise to a capital gain. Coupled with code section 1241. Beginning on page 729, there's the discussion I mentioned to you before. We're going to see this in the problems where if someone creates a life estate in property, and I said this commonly comes up in a marital context where 2 people are married and one person dies and sets up a life estate for the surviving spouse. We're going to see the dynamics of what's spelled out on these pages, 729, 730, 731. To see in the problem. So I'm going to hold off on that. We'll describe that in a few minutes. Watkins is a very, very easy case to read. I'm not sure why it's in the case book. I don't know if, I know Maduka, I hope your daughter's feeling better. Did you have a chance to read this? Terrific, but
No, I didn't get.
didn't get a chance. Okay. Yeah, Shervan, any chance to read this? And David? Be warned, guys, that with the exam coming up, you don't want to read this too far after the fact, right? John Watkins, anyone else read it? Or hear my monologue, or maybe even Kyle got this far? You guys get to hear my monologue. Taxpayer won a lottery. Was taxpayer happy or not? I'll have to answer that question. Well, I guess he was happy from winning the lottery, but immediately gets divorced. So I guess
Smart guy.
things weren't always so peachy keen. Wins the lottery, significant money, $2.6 million, and he pays $200,000 in consulting fees, which to to me is, I'm not sure what he bought for $200,000 in consulting fees, so sign me up for whoever is willing to pay that. Said that, $200,000, and the question is, he takes his lottery winnings and he essentially sells his lottery winnings, right? You can sell your lottery winnings, right? You get discounts based on interest rates, right? The question is, if you sell your lottery winnings, what is the character of the income? Reported as capital gains. Was that the appropriate tax treatment? Justin, you're shaking your head.
No.
Income, right? Just like in the Hort case, you can't take rental income and somehow transform it to capital gains. Similarly, you can't take your lottery winnings and somehow transform it, right, guys, into something it isn't. It's going to give rise to ordinary income. Page 735. Agent, enter into a contract with the national insurance company, manage its state office for a 10-year period. After 2 years, the company decides to continue its state operation and agrees the agent to pay $50,000 to terminate her contract. Even if you haven't read the material, it doesn't matter for my purposes. Treat that. How should the agent treat that $50,000? Yeah. Lease doesn't mean an agreement, right? It's not meant to be a trick question, guys. What code section? Come on. Right? If someone pays you to work, that's income. If someone pays you not to work, right, it's income. Agreed? Code section 61, nothing fancy. Stranahan case, well, you can't recall it because you didn't read it yet. That as it may, let me just give you the broad outline of Stranahan. Suppose I own IBM stock worth $10,000, and every year it pays $500 worth of dividends. Okay, everyone got the visual? I own $10,000 worth of IBM, and every year it pays $500 worth of dividends. I sell to my son the right to dividends for the next 10 years, and he pays me, say, $4,000. He discounts it, right? Because of the time value of money. So instead of paying me $5,000, he pays me $4,000. How should that payment of $4,000 be treated? For the right to my future dividends. Capital.
Because there's an exchange.
What are dividends? What kind? Ordinary, right? Now they may get preferential rate treatment under code section, but just like a rent substitute, isn't this payment to me a substitute for the dividend payments? So it would be $4,000 of dividending. Landlord owns 2 contiguous parcels of land. Landlord leases both parcels to tenant for $1,000 per month, or a total of $24,000 per year. The rent is payable at the end of each year. 10-year period. Following events which occur more than 1 year after the lease is signed, what are the results if? If landlord sells the right to rent both parcels prior to any rental payments being due or paid, or to a third party for $200,000. What happens if the landlord sells the right to rental payments? Great authority, Raza. What? That would give rise to capital gain, and you're saying it's ordinary income. Is this a substitute for rent payment? Does that sound familiar?
Court case?
Court case, right? Court case, guys. Right, Yen? Ordinary income. The landlord, if tenant pays landlord $20,000, cancel both leases. In this case, Max. What's the character? Okay.
Would it be, it's also ordinary income?
This is the Hort case in one line, guys, right? $20,000 of ordinary income, period.
Long-term capital gain.
Why? This is the instance, Wendy, where code section 1241 would apply, right? or a lease, right? Person is being paid essentially for their leasehold interest. So this would be 20,000 in long-term capital gain. What happens to question D? To tenant after subleasing one of the parcels of land who asked for $1,200 per month for a 5-year period. The subtenant pays tenant $10,000 for all of tenant's rights in the lease on the parcel, and now releases tenant from the lease and accepts us as the new tenant. Isn't this, guys, almost the identical fact pattern of what we looked at in Metropolitan? This is the fact pattern. It's capital gain, and now we not only at Metropolitan, we have a code section 1241 directly on point. The tenant, if subtenant leases one of the parcels of land for tenant at $1,200 per month for the remainder of T's 10-year period. Ordinary income, right? It's just a rental payment, right? Nothing fancy here, so don't get caught up. It's all ordinary income to tenant. Question 4. B owns income interest in a trust which B purchased several years ago. The remaining income interest has 20 years to run after the date of the sale. Right below, and B's adjusted basis and the remaining interest is $50,000. A picture view of beneficiary owns an income interest in a trust which B purchased several years ago. The remaining income interest has 20 years to run after the date of sale. Right below, in B's adjusted basis, the remaining interest is $50,000. What happens if she sells her entire interest for $60,000? So picture view, I'll use Robert as the B here. Robert decides he's going to buy an income interest in a trust, which is very unusual. We're just putting this problem here for pedagogical reasons. It doesn't happen every day. I've been doing this a long time. I've never seen it happen, but just go with the flow, okay? So Robert purchased the interest for $50,000 because that's it says his adjusted basis is $50,000. He sells it for $60,000. Well, here are the words sale. In this case, you'll tell us what code section applies if you hear the word sale. Yeah, 1001, right? Realized?
Oh, the amount realized is 60,000.
What's the basis? 50. Gain or loss? Right? Now, if you look here, what the author suggests is, share this with you, that it's not entirely clear what the gain would be here on page 731. Look at what the authors say. Characterizing the gain. Page 731. The authors say that this is not entirely clear what the gain on the sale is. But they say, through the ambiguity, they would argue that it's probably capital gain. Probably. B sells 1/4 of the income interest for $15,000. Well, what's the amount? Yeah, we're going to go with 1001 again, right? What's the amount realized here? Agreed? What's the adjusted basis? 500, right? 1/4, right? Loss here, guys. Much. And at 2,500, again, probably long-term capital gain. What happens if B received the income interest as a gift? Okay? Didn't purchase it, but then assuming the same basis, adjusted basis, and B sells the entire interest for $60,000. We know what the amount realized is. Everyone agree? $60,000, right? Everyone agree? If the amount realized in this question is $60,000, right? She's going to tell us 1001. The amount realized is $60,000. What is the taxpayer's adjusted basis? I'm just going to call this your attention. Pull out code section 1001E. He says, determining the gain or loss disposition of a term interest in property. What is a term interest? If you look at 1001E2, it includes the term interest means income interest in a trust. That's what B has here, right? B has an income interest in a trust. It says, person has a term interest, that portion of the adjusted basis of such interest, which is determined pursuant to code section 1014, 1015, or 1041, right? Look at you guys, you know all three of these code sections, right? 1014 deals with death, 1015 with gift, 1041, right? Spousal transfer, agreed? Adjusted basis is a portion of the entire adjusted basis of such property shall be disregarded. So what this means, guys, I'll translate it for you, is that you acquire this property, a term interest in property by gift. Adjusted basis is what? It says it shall be disregarded. That's what code section 1001E says. So the gain here, contrary to your intuition, would be $60,000. Problem. Right there in the code. Not making it up.
No, I
I
got it.
promise. Just want to make sure.
Why is that the exception? Or why are,
Easier to illustrate in the next problem. And I'll show you in the next problem why it's considered zero. Suppose B, in this case Robert, inherited the income interest, and B and the remainder person both sell their interest to a third party, with B leaving. I'll explain this in a second. Hold it. So this is A. B. Have this time Robert inherited his income interest, and both the Robert and let's just suppose Raza was the remainder beneficiary. In other words, after Robert's death, Raza got the income interest. Okay, so she's the remainder beneficiary, and together they're going to join and they're going to sell the entire interest, right? Not just the income interest, but also the remainder interest. And Robert's selling his income interest for $60,000. The question is, does 1001 apply? And if you look at 1001E3. It says paragraph 1 shall not apply to a sale or other disposition, which is part of a transaction in which the entire interest in property is transferred. So guess what? If the term interest holder and the remainder beneficiary join, 1001E does not apply. And in this case, the gain here would be how much? $10,000 from capital gain. This is problem C, not A. Problem D. And problem E, and then we'll talk about the policy. Problem E says, what happens if Raza, who has the remainder beneficiary, for remainder interest, 150, that's her amount realized. Her basis, we're told, is 100. What's her gain or loss here? 50, right? Raza get to use her full basis here? Because when you look at 1001E, it only applies to a term interest holder. Does Raza have a term interest holder, guys? No. She's a remainder beneficiary. She doesn't hold a term interest, right? She has a remainder interest. It's not defined. She's just under the normal rules of Code Section 1001. You might say, why does the taxpayer get the short end of the stick where the basis is disregarded in question C? And why is that what ends up happening when someone like Robert gets this property, and there's something called, the authors direct us to it, the uniform basis rule. And what ends up happening is Robert's going to get the income over the next 20 years. Everyone understand that? And ultimately, the property is going to go to Raza. Right? Robert buys the property. Ultimately, but in my case, in problem C, I gift him the property, right? I gifted him. And his basis initially is $50,000. Agreed? Ultimately, if Robert sells it to a third party like Maduka, okay, and then ultimately the property passes to Raza, what is Raza's property basis going to be in that property? Remember, even though Maduka has the property, she paid 50. Soled originally had the basis, the property, and I gifted to Robert with a basis of 50. Everyone agree? Maduka, during the next 20 years, she paid $20,000 to get this income interest. She's going to amortize her $20,000 cost. That's what she paid. So over that term, she's going to, whatever income she gets, she's going to offset part of that income with what she purchased, her cost basis. By the same token, Raza, when she gets this property, ultimately, even though Maduka paid for it, the remainder beneficiary, she's going to theoretically getting it from Robert because Robert is the measuring light. When Robert dies, or at the end of the 20 years, it's going to look like the property came from Robert to Raza. Well, what was Robert's basis in this property? It was 50. Well, because I gifted it to him. So Raza is going to take that $50,000 basis. If we allow him to use that to offset his income, if we allow him to use the 50,000, then that 50,000 would be used twice. It would be used by Robert and it would be used by Raza. So you can't use that $50,000 twice because Section 1001E precludes the recipient taxpayer, in this case Robert, from making double use of that $50,000 basis. Think about it. I'm just telling you that it didn't come out of thin air. Does this come up all the time? No, but 1001E, again, creating a strange result in your mind, perhaps, but 1001E says the basis shall be treated as zero. Page 736, correlation with prior transactions. I'll give you a simple fact pattern. You have a corporation that is ending its life, okay? It's being liquidated. Liquidation, I'm just sharing with you guys, when you deal with corporate tax, there's a code section 331. It says on liquidation, shareholders treated it as a sale or exchange, and if they get $100,000, picture Wendy is a sole shareholder of a corporation. Her basis is, say, $40,000. Just a basis. And when the company liquidates, she gets $100,000. Is Wendy happy? Hey, Wendy, you happy? Sure. Admittedly, Wendy, you're going to have to pay tax on $60,000, but that's how the chips fall, right? Picture, if you will. There's a knock on Wendy's door. That's what. There's a knock on Wendy's door, and the creditors of the corporation say, Wendy, you got to pony up $5,000. Okay? And you might say, Wendy might say, hey, it's a corporation. You can't come after me, right? That might be your first reaction from your legal class. Wendy, can they come after you for this $5,000? The answer is yes. Why? You got a distribution of $100,000, right? If you recall, you got $100,000 in cash, and as a distributee of the corporation, creditors can go after distributees, right? But they can't go after you personally if the company just failed and you've got zero. They can't get anything. But as a distributee, they can get $5,000 or up to $60,000, right? Excuse me, up to $100,000. When Wendy now pays the creditor $5,000, how would Wendy like to treat that $5,000 payment? And let me just make an observation. How did Wendy treat this $60,000 for tax purposes? What is the character of this gain? Her stock a capital asset? Tantamount to her selling her stock? Would this give rise to long-term capital gain? Yes. Wendy treats it as a very happy camper, long-term capital gain. 2 years later, that knock comes, she pays back the $5,000. They treat that for tax purposes, guys. Wendy would like to treat it as how?
Loss.
Ordinary loss, right? If I just had to shell out $5,000, she would say there's no sale exchange, right, Shia? Just had to come up with $5,000, right, Shia? Supreme Court, I think this is Supreme Court case. Yeah. 1952 says what? Well, suppose the creditor had come knocking on the corporation's door before the company liquidated. Suppose how much would Wendy have gotten instead? Well, there would only have been $95,000, right? And guess what? She would have had how much? $55,000 of long-term capital gain. So, the U.S. Supreme Court says, look, if she treated as capital gain, the gain, consistency requires she treats this $5,000 loss as how? A capital loss. Wendy is not a happy camper because now Wendy has to endure the limitations under Code Section 1211. Smith stands for a doctrine, the consistency doctrine. That you have to be consistent with respect to your tax treatment. That's what this whole case is about, guys. Oil on page 740. Taxpayers in Scully received $505,000 but there's a special depletion credit, and due to the depletion credit, which you're not responsible for, they only had to report $366,000. And there's a depletion credit of 27.5%. Depletion credit. So picture, if you will, they collect 505, but isn't this a great deal? They only have to report 366. Okay, totally legitimate. Only has to report approximately 75% of what they receive. In another tax year, they have to reimburse customers. And how much do they have to reimburse? They have to reimburse their customers the full 505. Taxpayers would like to take a deduction for 505, right? That's how much they were out of pocket. The court says. Excuse my language, wise asses. You only had to report 366. Consistency with the prior income received, and under the Arrowsmith doctrine, you only can deduct 366. You can't receive 505, report 366, and then reimburse and take a deduction for the full thing, right? Does that make sense? To Wendy, it's more painful because this loss of 5,000 happens in a different tax year. So Wendy is particularly peeved because in a different tax year, this capital loss can be subject to limitations. It says, let the chips fall where they may. But that's Scully oil, guys. That's a reflection doctrine. Beginning on page 745, authors discuss several code sections that statutorily create special rules. And sometimes they're pleasant. In Code Section 1245, lasting treatment of property, and artificially accord sale or exchange treatment with respect to patents, okay? So 1235 is a good thing. Page 747, section 1234 talks about the neutral status of options. Sort of like a chameleon, they'll take on whatever status the underlying assets have. Section 1236 deals with dealers and securities. 1236 deals with dealers, securities. They have to record whether or not what they acquire is inventory. Dealers may have inventory, or they may have investments. So the dealer is responsible for recording why they're holding particular stock. Section 1237, I already discussed. We discussed that in the context of Maudlin, and taxpayers are given a special break that they own undeveloped real estate, that they can sell up to 5 lots without enduring ordinary income. They can command capital gain treatment. Section 1234A, spelled out on page 749, talks about the cancellation, lapse, or expiration of an option. It's treated as a capital asset. In that case, an option simply lapses. Section 1241 we just discussed. With Metropolitan Building. And Section 1253 on page 750 is less favorable treatment with respect to franchises, trademarks, and trade names. It is a not treated as a capital asset. The biggie, the big enchilada, the one that you really can expect several questions on for the exam and final exam, begins on page 750. On page 750, discussion towards the end of last class, code section 1231 assets, which, again, for exam purposes, are 1231 assets capital assets? Capital assets, Raza. Shaking your head, no?
Yeah, they're not capital assets.
What's your authority? Capital assets or not? Where would you look? For a capital asset. Where's the definition of capital assets, guys? Come on. Are 1231 assets capital assets? Categorically not. They are not capital assets. Can they get capital gain treatment? Absolutely, right? But do not for exam purposes or for when you're in your practice. 1231 assets are not capital assets. Remember, let me give you the general rule, and then there's 2 important exceptions, okay? And these exceptions can come up all the time. Rule. Remember, I don't care how you do it. If the gains exceed the losses, what is the character of the 1231 dispositions for the year? Capital. All gains, all losses are considered capital. If the gains exceed the losses, everything's capital. Firstly, if the losses exceed the gains, what's the character? All ordinary. The losses exceed the gains, it's all ordinary. The general rule, you got to know that rule, right, guys? All the time. And just to remind people, signature attribute, it's important for when you, on exams or with clients, what do you have to be? And with your significant other, guys employ that this weekend with your significant others? Right, Elena?
Yep.
Say periodically, I'm losing my patience, but you have to at least have some patience to lose it, right? That's the general rule. There's two exceptions. So the authors first, rightfully so, give us the general rule. The hodgepodge, okay? That look at all your gains and losses and see which exceeds which. The word hodgepodge is not, this is on page 751 in italics, the word hodgepodge, if you're wondering. You will not find that in the Internal Revenue Code, hodgepodge. But since we're in the 19th edition, and since this is the most popular textbook used, reason in the last 20, 30 years, hodgepodge has come into the vernacular of tax practice because so many people use this textbook. If you're looking for it in the code, you're not going to find it. 752 and then 753 are two important exceptions. Sub-hodgepodge, something truly horrific happens. This is 1231A4C. Something truly horrific happens. Fire, shipwreck, some horrific event. Or business property. The sub-hodgepodge, and you can have loss treatment on that property. So if you have a particularly bad event, a car you use in a business burns into smithereens, you experience a loss on the car. You can get ordinary loss on the car, and even if you have 1231 gains for the year, you can have capital gains on your on the main hodgepodge. Okay, so you would have a main hodgepodge reporting gains and capital gains, a sub hodgepodge reporting an ordinary loss, which is weird because now you have both ordinary loss and a capital gain from 1231 assets, which normally you're either one or the other, right? It's usually binary. But if there is a sub-hodgepodge, then you can have a foot in both worlds. Weird, right? But possible. Also, picture, if you will, just a sample or two, picture land that you bought for 20. You bought several pieces of land, $1,000. In year one, you use the land in your trade or business. Year one, sell one piece of land, you had $80,000 worth of gain. Two, you sell a second investment, you lose $5,000. Three, you sell another piece of land, this time for 30, adjust the basis of 20, have a $10,000 gain. What is the character? Well, here the gains exceeded the losses. What's the character? Gain, right? Losses exceeded the gains. What's the character? Gains exceeded the losses. I should have said the losses, the basis exceeded fair market value, so that was ordinary. Here we have a gain. But Code Section 1231C, Code Section 1231C says, look back 5 years, and to the extent you had 1231 losses in your prior years, to the extent you had 1231 losses, to that extent, this 10,000 has to be recharacterized. And In this case, we look back, we had 5,000 of prior losses, so this 10,000 would be 5,000 of capital gain and 5,000 of ordinary loss. You might say, why saddle this taxpayer? Excuse me, did I say ordinary loss? I apologize. 5,000 of ordinary income. 5,000 of ordinary income. You might say, why would this taxpayer get 5,000 of ordinary income? Fair question. Because otherwise, what would taxpayers do? Knowing we're strategic in this room, what we would do is we would take our 1231 losses, right, in certain years, get ordinary loss, which is great. It's not subject to the loss limitation rules. And we take our capital gains in other years, right? We would be very strategic. And because of the up or down, we would, again, our strategy would be take losses in one year, get ordinary loss, get gains in other years, command the capital gains rates, and play a game with the code. Code section 1231C says, no, not so fast. To the extent you have losses in the prior years, losses will recharacterize the current year's income. Let me repeat. Mistake on exams. 1231C for your notes, will it ever change the numerical outcome? Will it ever change the numerical outcome? And the answer is no. Oh no, it will never change the numerical outcome. The only thing it will do is change the character of the income, right? It will change the character of the income. That, and you're going to have to see some problems to really absorb this, guys. But telling you that we have our general rule and we have our exception. General rule, and then we have our exception. Beginning on page 754, Wozniak case. This is not a famous case. Wozniak is not a famous case. The question in this case is the taxpayer, real estate that the taxpayer rented, only sold for a loss. The taxpayer, very unusual here, would like this loss to be capital. Why? Because if the taxpayer can get a loss which is capital, in this particular case, the taxpayer can carry forward that capital loss, right? Code section 1212 allows the taxpayer to carry forward the capital loss. In contrast, if this is an ordinary loss for the year that it was incurred, the loss would have been extinguished because during that particular tax year, the loss couldn't be used and it would simply have been extinguished. So the taxpayer here would like to argue, is this land that gave rise to the loss a 1231 asset or not a 1231 asset? And what the taxpayer argues is that it was not a 1231 asset. Unusual, most taxpayers want 1231 status. Taxpayer is saying, look, I only own one piece of land. It wasn't really used in a trade or business. It was used for investment purposes. I inherited it. I never intended to use it as trade or business. What does the court hold here? The court holds, you know what? Even holding one piece of land and leasing it out is sufficient for it to be a trade or business. So it rules against the taxpayer and says, this is a 1231 asset, and as such, it's an ordinary loss. You can't carry it forward. Game over for the taxpayer. To make your notes confusing, on page 757, there's a note that follows, With a different case, the court held to the opposite. And if you hold one piece of property, it's not sufficient to be a trade or business. So, to point out that some of these things, guys, do not lack the clarity, or some of these things lack the clarity that you would like. At the top of page 757, the first full paragraph, it says, in our view, petitioner's activity in renting out the Sagrest or Rest property for a fairly continuous period of 4 years at a substantial rental, together with the concurrent claiming on their income tax returns, these expenses incurred such rental activity during the depreciation establishes the use as a trade or business. So just sharing that. If you have a trade or business, courts are apt to treat it as a 1231 asset. Now, Williams v. McGowan is not an easy case to read. Okay, let me state that. Williams v. McGowan is not an easy case to read. Having said that, the proposition it stands for is pretty straightforward. Picture, if you will, you own a proprietorship, okay? You own a small mom and pop bodega, okay? Somewhere you sell apples, oranges, you have some machinery, you have a cash register, you own, you're like a little supermarket, right? Sell it. What kind and experience a gain? The taxpayer would like to take the position, if you sell your business, well, the taxpayer looks at Code Section 1221 and says, gee, sold my business, everything's a capital asset except the exceptions, right? I look at the exceptions, and the exceptions say inventory, accounts receivable, 1231 assets, but I sold a business. It doesn't fall within any of those exceptions. So the taxpayer would like to command a capital gain treatment. Agreed? Should the taxpayer command capital gain treatment? And what Williams v. McGowan stands for a very simple proposition, notwithstanding the fact that it's not an easy case to read. Is that when you sell a business, look at its underlying assets and not just the business in its entirety. So in that particular instance, if you sell the business, you have to see how much inventory you have, how much 1231 assets you have. Do you have any capital assets? So you have to go asset by asset by asset. So Williams v. McGowan, again, stands for a simple proposition to break down the business. Break down the business. So, on page 761, there's a detailed questions that we're going to go through. And then, if you look at chapter 22, we're going to learn about essentially 3 important code sections in chapter 22. Code sections 1239, 1245, and 1250. 1245 is the one that comes up most often. What I'm going to do is just spend the next 10 minutes explaining this, and then hopefully the next class, I'm hoping it's not too ambitious. You guys really, 1, have to catch up, and 2, believe it or not, be ready for chapter 22 on Wednesday, all right? Now, let me try to just explain the philosophy underlying this because it makes it easier to understand. You buy property for $100,000. Suppose you take $1,000 depreciation deductions. Just the basis in the property. $2,000. Everyone agree? Well, you buy depreciable property for 100,000. You take 60,000 of depreciation. Your adjusted basis, right? It's going to be 40,000. Code section 1016, adjusted basis, code section 1011. It's all there, right? This is 1012. Everyone's smiling. It's all good. Now, suppose problem A, for 120,000. B, you sell it for 65,000, and C, you sell it for, think of a number, 25,000. Okay, so in other words, these are three different prices. You'll appreciate this. You hear the word sale, what code section? 1001, right, Shia? Yes. All right, great, 1001. So if you sell it for 120, any gain or loss, guys? How much? Everyone happy? Everyone can say 80,000, right? And if you sell it for 65, gain or loss? How much? How much? 25, right? If you sell it for 25, how much? Right? Okay, now, we're halfway home. We need to know the character, right? Character of the 80,000. What should it be from a policy perspective? If you were Congress, you're Congress. In a bit, you're wise people, you Congress people. Here's my members of Congress. And it's void of party, Republican or Democrat. This is, I know that's hard to believe, but you take a step back. There's no party affiliations. And I don't think there should be in this case. How would you tax this? A gain of 120. Excuse me, the gain of 80. Justin, you didn't scratch your chin enough. No. Okay. The taxpayer, what was this $60,000? What kind of write-off did it get? What area of capital loss is that 60,000? Right? You got $60,000 of ordinary deductions. Everyone agree? Well, I got $80,000 of gain. What's good for the goose, good for the gander? What do you think we should do with that 80,000? So just say the numbers, Shervan.
0.
Would be what?
Ordinary.
How much ordinary income, Shervan? I don't think you were scratching your chin enough. One more time. How much ordinary, how much capital gain?
In 20 ordinary. 60.
Yes!
Be consistent.
Okay. See, I'm glad you scratched your chin a little bit. It works. All right? During the exam, keep going. All right? 80,000 should be bifurcated. And that's what it's going to be, guys. There's going to be 60,000 of what's called 1245 recapture income, right? Recapturing the prior deductions. 20,000, 1231 gain, and we're going to be patient until the end of the year and see if the gains exceed the losses exceed the gains. If this were the only sale, it'd be capital gain. Agreed? If we only sold one tractor, this was the one tractor, this would be capital gain. Agreed? On the second tractor that we sold and we had a $25,000 gain, what's the character, Maduka? Jen?
Yeah.
Maduka, the answer is? Loud enough. We already said it was gain, right? Fine, yeah. We sold it for 65. The basis was 40. We had a $25,000 gain. What's the character of that gain? Okay, Nelly?
1245 recapture.
What's the character? ordinary. Everyone agree that 25,000 is ordinary, all ordinary, right, Maduka? 1,000 of ordinary income.
60.
Less than 60, we're not going to penalize the taxpayer, right? We're not going to penalize the taxpayer. 25,000 of ordinary income. I recapture income. Sell it for 5, so this is all ordinary. You sell it for 25. Ordinary loss. What's your authority? Just sold. What's the character, Wendy? Why? Agree or disagree? Yeah? Justin? What kind of asset is this, guys? Categorically not a capital asset. Is it? Asset is 1231 asset. So if this is a $15,000 loss, what is the character of the loss? Yes, because the losses exceeded the gains, right? So that would be a 15,000 ordinary loss, right? And I get to minus double the points. If anyone says a 15,000 ordinary recapture loss, double deductions, okay? Because, and if someone subsequently asks you who you had as a professor, lose my name if you say that, okay? It is ordinary loss. These are 3 tractors. Let's see if you guys really know what you're talking about. Suppose all 3 tractors were sold this year. All 3. All 3 tractors. The character of the income. All 3 tractors were sold. These were 3 tractors purchased several years ago, and all 3 of them are sold the same year. Wendy's chomping at the bits.
You have ordinary loss and
Hold on,
25.
slow down. How'd you get that?
I add 25 to 80, 105, and I subtract it.
Too fast for me. So, Shervan, let's do this. I can put you on the spot. You stand up for 1 second. During the exam, I won't stop you, Shervan, from standing up. So, all right, good. It's good to be religious at this moment. Are the gains exceed the losses, or the losses exceed the gains? And you can do this.
Exceed the loss.
What's your evidence for that? And of course, you would go like this, right? Right hand up, left hand down. See, right? Are sold. Do the gains exceed the losses, or the losses exceed the gains? First of all, does 1245 go into this equation? Yes or no? 45 go into gains exceeding the losses exceeding the gains? No. Okay, everyone understand 1245 is not part of the equation. So Shervan, we're going to take that 60,000 at 1245 recapture off the table. Agreed? Exceed the losses, or the losses exceed the gains?
Exceed the gain.
Gains exceed the losses. We got 20,000, 25. So we have how much of gains? 45. How much of losses? Do the gains exceed the losses, or the losses exceed? The gains exceed the losses. Shervan, you were right on. Right. All right. Now, having said that, what is the character of the income here? Okay, so that 20 would be capital gain, this 25 would be capital gain, and this 15, loss. Because once the gains exceed the losses, it's all capital. You there?
Not really.
Write it down, review it. Wendy, you understand the scenario? There's 3 tractors that are being
I
sold.
see what I'm not understanding. 25 is not the 1245.
Oh, by the way,
which
I
one?
screwed up. I got too excited. Wendy is 200% right. Don't write this down in your notes. She's 200% right. This is 1245 recapture as well. Okay? And as Wendy's pointing out, because I got too excited, I apologize. The 1245 is off the table, right, Wendy? So it's not part of, but good news, Chevron. The gains still exceed the losses, right, Wendy? Yep. So we still have 20,000 in capital gain, right? And 15,000 in capital loss because the gains still exceed the losses here, right? This is still ordinary income. This is still ordinary income. Because 1245 is bad news for taxpayers. 1245 is never good news for taxpayers, guys. As Wendy points out, this 1245, the table, this is off the table.